Hello everyone, this is Vinita Nair from Vinod Kothari and Company, and this video is to discuss on the recent industry standards note which was rolled out in relation to the disclosures to be made for related party transactions. So as we are all aware that RPTs is something which is very close to the heart of the regulators, and therefore maybe on a Valentine's Day we had this wonderful circular being rolled out by SEBI, indicating the requirement to give enhanced disclosures to the audit committee and to the shareholders while taking the related party transactions for approval. The circular comes into effect from April 1st, 2025. And this again leads to a lot of queries on what is the applicability? Is it transactions to be undertaken or the approvals that are taken after 1st April? What are the actionables? What is now the role of audit committees? There's some enhanced role that the audit committee is expected to discharge. Is there a change in the regulatory regime in the manner in which the RPs were identified or RPTs were identified? So there are a lot of questions in relation to the ISN. In fact, we had hosted a workshop last week attended by over 100 participants, and there were a lot of queries, which was around a 3 hours workshop, a lot of queries answered satisfactorily. And therefore, this video is to give you a gist of what is the regulatory requirement and what is the expectation and what is the actionable on the listed company. So I'll quickly share my screen and the presentation, of course, is only for academic purpose. It's not for solicitation of any professional assignment. Now, the industry standards note rolled out on 14th of February and becomes effective from 1st April. The standards have been framed by the Industry Standards Forum, which comprises of the 3 industry associations, and it also has the backing of SEBI. So it is framed in consultation with SEBI. So therefore, there is a regulatory backing. Now, the circular comes into effect from April 1st. So therefore, should we say that it applies to all the transactions undertaken on or after 1st April? If we take that interpretation, then in that case, the validity of the existing approvals taken on or before 1st April will stand exhausted, which cannot be the intent. So the material RPTs that were approved in the last AGM or the approvals for maybe specific contracts or the omnibus approval, which must have been granted by the audit committee on or before 1st April, cannot lose its validity merely because of the circular coming into effect. Let us understand that the intent of this circular is not to change the regulatory regime. The regime remained the same. The manner of identification of RPs, RPTs, the manner of taking approvals from the shareholders, audit committee, validity of those approvals all remained same. What now changes is the list of information, the disclosures that you present to the audit committee or to the shareholders in case of a material RPT for taking the approvals. So that is the only part which has changed. And therefore, in our view, this applies to the approvals that are taken either from the audit committee or from the shareholders on or after 1st April 2025. So accordingly, suppose the omnibus approval was already taken before 1st April, considering most of the companies take it in the last quarter of the financial year. In that case, even though the transaction is being undertaken after 1st April, this circular will not have an impact. But if the approval itself is being taken after 1st April, in that case, the revised requirements of the ISN will become applicable. Similarly, for a shareholders approval where the shareholders approved material RPTs, say in the last AGM or maybe by way of EGM or a postal ballot thereafter, and even though the transactions are undertaken after 1st April 25, this circular will not have an impact. But if we are approaching the shareholders on or after April 1st, 2025, in that case, the revised disclosure requirements will become applicable. Now, what happens in case the transactions were already approved prior to 1st April, but are being modified, or we are taking for ratification, or we are taking for renewal? So there is any kind of modification or a fresh approval is being taken from the audit committee or the shareholders. In that case, because the approval is being taken after 1st April, the requirement or the disclosure requirements as per the ISN will become applicable. Now let us understand what are these disclosures to be made. So the circular identifies three different kinds of disclosures, and we say there is one more kind. So either it's a case of comprehensive disclosure, or there is a limited disclosure, or there is a minimum disclosure, or there are no disclosures. So in which situation each of these apply is something that we would now quickly understand. But before that, let us understand the concepts. One is the concept of material RPT, which we are all aware that those RPTs which cross the threshold of either 1,000 crore or 10% of the consolidated turnover of the listed entity, whichever is lower. So this is the material RPT or MRPT. There is now a new concept of ORPT. We say other RPT, but the RPT is such which is one undertaken either with a promoter or a promoter group or a promoter group interested entity. So this promoter group interested entity is again a new concept. What it means is persons. So it could be companies, it could be firms, LLP, trust. So persons in whom the promoter or promoter group has a concern or interest. And the concern or interest should be in the form of either 2% or more of voting rights, or the promoter is a CEO or a promoter, trustee, etc., of that other entity. So there is a concept of PGIE, such entities over which promoter or promoter group have a concern or interest. That gets identified. So if the transaction is with a promoter or with a promoter group or with a PGIE, I need to see what is the quantum of those transactions. If the quantum of transactions, all the transactions proposed to be undertaken in one financial year. So if the quantum of that transaction is crossing the threshold of Regulation 30, Subregulation 4, if we recall that in 2023, effective July 2023, LODR Second Amendment, the Reg 30 norms had undergone significant change, wherein the concept of quantitative threshold was prescribed of 225, which is either 2% of the consol turnover or 2% of the consol net worth or 5% of the average absolute PAT of last 3 years. So whichever was the lowest of the three parameters became the materiality threshold for that listed entity for the entire financial year. So this threshold now becomes relevant even in case of RPT, because whatever is that threshold applicable for a particular financial year, the listed entity will have to see that whether the transaction is being undertaken with a promoter group or PGIE, whether the value of transaction with that related party, aggregate of all transactions in a financial year, whether it crosses the materiality threshold or not. If it crosses, then we consider it as a ORPT, that is an other RPT. If it does not cross that threshold, and if it is not with promoter group or PGI, we refer it to a residual RPTs, RRPT. So now when we look at the disclosure requirement, first we begin is what are we looking at? That we look at the transaction being undertaken with the RP, we aggregate the transaction for the entire year and see whether it is a case of material RPT. If it is a material RPT, then I need to give a comprehensive disclosure. Now, before that, just 2 points I missed. The ISN also classifies or segregates the RPTs into 2 buckets. The transaction that is a balance sheet item or the transactions which are a P&L item. For example, loans, guarantees, investments, borrowings, these are all impacting the balance sheet. So therefore, those are identified as a balance sheet item. Similarly, sale or purchase of goods, payment of royalty, etc. These pertain to P&L expense item or an income item. So then those are classified as a P&L item. So the inclusive list is something which has been provided in the ISN. So accordingly, the RPTs now get segregated in balance sheet and P&L. Why is it relevant is something we'll just understand shortly. So first we see whether the transaction with the related party is a material RPT or not. If it is a material RPT, I need to do a comprehensive disclosure. If it is not a material RPT, then I look at whether I'm transacting with an RP who is either a promoter or a promoter group or a promoter group interested entities. I'm saying whether I'm transacting with an RP who is either promoter group or PGI. So let us understand that there is no new set of RPs that are to be identified. The promoter group interested entities is not a new set which now I'll be monitoring or tracking. I'll just identify those entities and map it across my existing related parties. So whether the list of related parties that a listed entity maintains, whether any of those related parties fall under promoter group, or whether it is such an entity which can be classified as a promoter group interest entity, which means whether the promoter or promoter group, they have a concern or interest of 2% or more of voting power or CEO, promoter, etc. So if I am transacting with such an RP, which is either a P, PG or PGIE, then I look at what is the quantum of transaction. If the quantum of transaction is more than the materiality threshold applicable to the listed entity, which means if it is a ORPT, then I need to give a comprehensive disclosure. If it is not an ORPT, then again, there is another check that we need to do. The nature of transaction, whether it is a balance sheet item related transaction, or is it a P&L related transaction? So if it's a balance sheet item transaction, I still need to provide a comprehensive disclosure. But if it is a P&L item transaction, then I just need to give a limited disclosure. Now, there could be possibility that the transacting RP is not forming part of, it's neither a promoter nor a promoter group or a PGIE. In that case, I need to look at what is the value of the RPT. Is it exceeding 1 crore or not? When I'm computing this 1 crore, I'm not looking at per transaction. I'm looking at the quantum of the entire RPT, value of all the transactions proposed to be undertaken during a financial year. So if the aggregate, on an aggregate basis, if the value of RPT is exceeding 1 crore, then I need to give limited disclosure. But if it is not exceeding 1 crore, then I simply give a minimum disclosure. So far we have understood there are 3 kinds of disclosure: comprehensive, limited, and minimum. We said there is also a 4th kind of disclosure, which also we'll be discussing shortly. Now, what are the contents or what are the components of each of these disclosures? So when we talk about a comprehensive disclosure, it is given in para 4 of the ISM, segregated into 2 parts. Para A dealing with the details about the RP and the nature of transactions that the listed entity or the subsidiary has had with the related party. So para A, if we need to understand the nature of the line items, so you provide a basic details of related parties. You talk about the relationship and ownership of the related party. What are the previous transactions with the related party, financial performance, what was the turnover, net worth, PAT during the last 3 years and the current year, etc., in relation to the related party. You talk about what is the quantum of the proposed transactions. Then para B talks about specific details. Specific details on one, the proposed RPT. So there is some generic details on the proposed RPT, which is to be provided, basic details of the proposed RPT. And then there are 7 line items where the nature of disclosure depends on the nature of transaction. So if I'm talking about sale, purchase of goods or services, then that is specifically covered under para B2. Similarly, we have financial transactions of loan, intercorporate deposits, advances given by the listed entity or the subsidiary under B3. B4 is talking about the investments made by the listed entity or the subsidiary. B5 talks about guarantee, where we are not including the performance guarantee. So the financial guarantee, surety, indemnity, comfort letter. Now one would wonder, what about comfort letter? Because comfort letter itself is not a transaction. So does that mean merely for giving a comfort letter, I need to take a prior approval of audit committee? In our view, the answer is no, because the intent is not to change the regulatory regime. The regime remains the same. So if in the garb of comfort letter, we look at the substance over form. So if the comfort letter is nothing but a guarantee which is being given, in that case, I'll have to give those disclosures. But if the comfort letter is just to provide a moral comfort, just to indicate the association, in that case, it's not a transaction. It will not entail the disclosures. Then B6 is particularly if there are borrowing related RPTs which are being taken for approval. B7 is specifically for the sale or disposal of asset or undertaking. B8 talks about payment of royalty. This is again very important because we recollect that there was a report which was rolled out by SEBI dealing with the payments of royalty which are done. And here the intent is not to disclose or give detailed disclosures for those transactions where, say, the listed entity is the brand owner. The Indian listed entity being the brand owner and receiving royalty from the subsidiaries. That is not what is getting covered here. What was the intent was where there is an upstreaming of profits. where the royalty profits are being paid outside in the form of royalty, professional fees, management fees, the various components of royalty. But the amounts are being paid by the listed entity and the subsidiaries, maybe to the promoter or the foreign parent entity or some other entity outside, or a promoter group entity. So where the listed entity or the subsidiary is not the brand owner, there is a payment of royalty happening. Only in those cases, these disclosures will become applicable. If listed entity is itself the owner and it is receiving the royalty, then those disclosures are not applicable. So comprehensive disclosures is everything needs to be given to the audit committee. But when we talk about limited disclosures, it is all of this minus some of the selective disclosures depending on the nature of transaction. So it's there's not a major difference. Some line items gets excluded. Of course, in case of sale or supply or sale or disposal, in those cases, the entire details relating to comparative bids obtained, whether we selected the best bid or not, what was the process for undertaking the bid, what was the bid amounts received, etc. All of these disclosures gets excluded in case of a limited disclosure. When we talk about minimum disclosure, we are only giving basic details about the RP and the transactions that the listed entity must have had with the RP. So it's only the basic details which we give in the minimum disclosure. Now, here comes the fourth disclosure, which we said that is no disclosure. So if there is an anonymous omnibus approval, which we take in terms of Companies Act as well as listing regulations, that is for unforeseen transactions, where the need for the transactions cannot be foreseen and the details which are required to be given is not available, where I don't know which party, what are the terms of transactions. In those cases, a blanket approval, or we say an anonymous omnibus approval, AOA, can be given by an audit committee subject to the maximum of 1 crore per transaction. Now, in these cases, there is no scope to provide any of these disclosures because I don't know the party with whom I would transact. I don't know which kind of transaction which we done. So therefore, in case of an anonymous omnibus approval, we say there is no disclosure that is applicable. So accordingly, there are 4 disclosures: comprehensive, limited, minimum, and no disclosure in case of an anonymous omnibus approval. Now, the highlight of the ISN is there is a requirement to provide a certificate to the audit committee. The certificate is to be provided by the KMP. It could be the CEO, CFO, or any other KMP, and by every promoter director. When we refer to a promoter director, we are meaning to say a person who has been identified as the promoter and who is on the board of the listed entity. So if there are like 3 promoters and all the 3 are on the board of the listed entity, each of the promoter directors will have to give this certificate. So this is in addition to the certificate given by the management by one of the KMPs. Now, what is the substance, soul and substance of the certificate? That one, the RPTs are not prejudicial to the interest of the public shareholders. The terms and conditions are not unfavorable to the listed entity. And third is that compared to terms and conditions, a similar transaction that the listed entity enters with an unrelated party. So it's a kind of assurance which we are giving to the audit committee. Now, what happens if you don't receive this certificate? If the management itself is not able to assure that the transaction is not prejudicial, if the promoter director is not able to provide this certificate, whether at all the audit committee can proceed with the approval. What happens when the disclosure is not required? So in our view, if the promoter is not giving this certificate, the fact has to be disclosed to the audit committee. And if it's a material RPT, then it also needs to be disclosed to the shareholders. But if the management itself is not able to give that assurance, then in our view, the audit committee should not be able to proceed with approving the RPTs, because the ones who have structured the transactions themselves are not able to confirm that it is not prejudicial to the interest of the public shareholders, then the audit committee will not have a basis to approve the transaction. So now here audit committee has a lot of additional roles. Firstly, it has to, of course, review the information which has been presented by the management. And there are specific line items where the comments from the audit committee is expected. So it has to ensure that the comments are given and these comments are also recorded as part of the minutes. So this becomes an additional actionable. Similarly, there are some confirmations which are to be given by the audit committee in case of a material RPT which is taken up to the shareholders for approval. We'll discuss that also very quickly. There is also a statement of assessment which the audit committee has to provide. Now, talking about specific comments. So I've just given few examples, like few of the line items where specifically the audit committee has to comment or to justify. For example, as a part of B1, which is the general details that I provide for the proposed transaction, a copy of valuation report or external report, if the company has obtained, that has to be placed before the audit committee. And the audit committee has to confirm that it has reviewed the basis of valuation. So what is this basis of valuation? Whether the audit committee steps into the shoes of valuer, whether the audit committee carries out the valuation exercise. In our view, the answer is no. The intent is that what was the basis? What was the purpose for which valuation was undertaken? What was the set of data which was provided by the management? For example, if the management provided certain projections, then whether the valuer simply relied on those projections or it sort of verified. So the audit committee will try to understand what was the data supplied and what was the approach that was followed by the valuer to understand whether the basis of valuation is right or not. If the valuer, for example, has simply relied on management confirmation, then the valuation will not have any any significance. So that is the role what the audit committee is expected to discharge. It is not itself sitting in the shoes of the valuer and carrying out the valuation. That's not the expectation. So there are several line items where either the audit committee has to comment or they have to provide a justification or they're expected to themselves justify. So each of these roles where the audit committee has some actionable is something which needs to be minutized while recording the approval of those transactions. Similarly, when we talk about the disclosures to the shareholders in case of a material RPT, the information which was placed before the audit committee also goes to the shareholders. Now, given the set of detailed disclosure, there could be a scenario where it may be felt that the transactions involve some commercial secrets or confidential information. So there is a scope for redaction, but that redaction also has to be approved by the audit committee, and the audit committee has to still assure the shareholders that even with the redacted information, you will be able to make an informed decision. So there is a lot of onus now on the audit committee members. There is a statement of assessment to be given by the audit committee that one, relevant disclosures were placed before them. Second, they have determined that the promoters will not benefit from the RPT at the expense of public shareholders. So this is something they have to expressly assert. It's not implied. They have to state it to the shareholders. They also need to disclose that they have reviewed. It's not just noting, they have reviewed the certificates which was given by the KMP and also what was provided by the promoter directors. They have considered the valuation report and they have given the requisite comments. So there is now enhanced disclosure requirement which will come from the audit committee. Apart from the basic data requirements, which will now form part of the explanatory statement while taking the material RPTs for shareholders approval. So therefore, all in all, there is a lot of actionables that comes for the listed companies. Firstly, do I need to revisit my RP list? The answer is no. I'm not identifying new RPs, but certainly I need to map the promoter group interested entities, promoter group, PGIE within my RPs. So that becomes an actionable. We need to revisit our RPT policy to ensure that it is aligned with the industry standards note. Similarly, we need to also understand the certification requirement. Who will give this certificate? What will be the format? Whether it will be one blanket certificate or I'll take one certificate per RPT. If the SOPs have been framed, which is something we strongly recommend, then in that case, that will also undergo a change. Most important is the sensitization by the listed entity. Sensitization of the audit committee members, the board of directors, to explain them about the new requirement. Sensitization to the promoters and promoter group because they are obligated to provide details of the promoter group interest entities. Sensitization of the KMPs and management, because they are the ones who will be collating this information, presenting it to the audit committee. They are the ones who will give the certificate to the audit committee. So therefore, that sensitization becomes very critical. Secondly, also to the subsidiaries, because the data, a lot of data will come from the subsidiaries as well in relation to transactions with the related party, terms of the transactions, etc. And if the RPT is undertaken by the subsidiary and the listed entity is not a party to the transaction, and if it's a significant RPT, which means it crosses the 10% threshold of the standalone turnover of the subsidiaries, or if it's a material RPT being undertaken by the subsidiaries, then those transactions will be approved by the audit committee of the listed parent listed entity. So therefore, these set of disclosures will be required. Now, who will give those disclosures in case of subsidiary? Whether the KMP of the subsidiary will certify, whether promoter directors will still need to give the certificate. So a lot of these questions also is something which the subsidiaries needs to be sensitized about. So the RPT agenda will also undergo a change. There will be a lot of enhanced disclosures which will now form part of the RPT agenda. And similarly, the manner in which we monetize the approval granted by the audit committee will also undergo a change. Therefore, there are a lot of actionables for the management, right from the certification requirement, data collation requirement, ensuring that you have the requisite details depending on the nature of transactions to be able to place before the audit committee and giving those certificate. So therefore, there is a lot of actionables, and the way in which the RPTs will be approved on or after 1st April tremendously undergoes a significant change. And yes, the preparatory steps will have to start here onwards, where we understand the nature, kind of information to be presented, how would we collate it, how do we standardize it, how do we summarize it, and how do we present it before the audit committee. So I would also request you all to visit our website, see the detailed video, detailed FAQs. We continue to keep on ramping it up depending on the queries that we get from the clients and what we face as part of advisory. So yes, thank you very much. Please share your comments and queries in the comment section. Thank you.